If you ask any professional trader or investor what they're looking at right now on the charts, they're probably going to mention oil. And why wouldn't they? It tends to be one that moves in times such as this. But what we really should be focused on is whether the Federal Reserve may be having to make some big shakeups to, of course, their overall plan. So today we need to discuss what that means for the market and, more importantly, why this zone is now the most important for us to be watching. What happens here could really dictate the next 3 months of market movements. And we've already spoken about how we thought that we may have already seen the low of 2023. So will we get a gap fill? And more importantly, have we seen the bottoming effect for probably the worst investment of 2023 so far, which has been treasuries? Stay tuned. We're covering stocks, commodities, and cryptos together. Well, welcome back everybody to the Daily Show where we discuss the macro lead indicators and the hottest charts. If you like anything to do with markets, remember to hit that bell icon and subscribe. But let's get into what happened. It was energy leading the charge with gold. The two markets that tend to do the best in times such as these were certainly rallying pretty hard. But there were also some other things that happened, such as some of the most sold off stocks and utilities starting to find a little bit of a bounce. Now, whether you like to admit it or not, markets do tend to do this. We've talked about it several times, and we kind of mentioned over the last 24 hours, we thought that we would fill the gap that was caused in the futures market action. A lot of it goes back to looking at previous history when we see things such as what's happening in the world right now. In general terms, we tend to see markets buying up, and of course, it's usually led by gold, oil, and obviously defense stocks. But is this a real bounce? Well, we posted over on our X or Twitter account, links in the description down below, that we see a big sign towards a potential real swing trade rally at this stage. And of course, if this continues up for another little bit of a session, it could mark the lows of 2023. In fact, we asked this question over on Twitter, and we'll do a poll to see what the members of the community think on YouTube a little bit later on. So stay tuned for that and make sure you vote. It's great to see these polls. We'll be doing more of them as well to get a bit of an idea on what generally people are thinking out there. So let's talk earnings and talk Thursday this week. CPI and, of course, big airlines coming through. It's going to tell us a lot through Thursday and Friday how the economy is going. Remember, banks always kick off earnings season, and then we go into the next week. This is a great chart for you to take a bit of a screenshot of because, of course, you can see here everything in advance. Tesla and Netflix kick off tech earnings, and then we go into about 2 to 3 weeks of incredibly important earnings, which usually allocate somewhere between 80% of the market capitalization size of the US. Also, stay tuned to the channel as well to make sure you're on top of the earnings expected moves. This is what the options market's telling us. Wells Fargo this week is expected to move between 6 and 7% during the earnings announcement. Now, as we often see, markets buy the rumor and potentially they'll sell the fact. But what we're seeing right now is a critical resistance that we need to talk about the key levels later on today's video because this is everything to the markets. Now, we also brought up treasuries, possibly the greatest meme position at the moment. Everybody's going on about how bad treasuries have been, and rightfully so. Treasuries have been a horrible investment now for the last 2 years. And if you asked anybody whether treasuries were going to be as low as they are right now, including myself, and you said that about a year and a half, 2 years ago, I'd say, nah, are you crazy? There's no way, dude. This is going to go down that low. However, they did. And that's exactly why you have to expect the unexpected. What's happening right now, though, is it's become a meme. It's become so hated that everybody thinks it's a joke. And at the same time, we've hit that -2 standard deviation. So I just want to reiterate here that treasuries could be seeing a turn point, and there's a lot of structure that's starting to appear in these markets. We're also getting to those kind of peak levels of negativity. We've already talked about the sentiment survey. We'll get another one later on this week, which we'll share. And of course, we have that bull-bear spread looking at -10, which usually tells you that it's a time where markets are potentially bottoming. It's kind of that sign that, yeah, it's maybe getting a little bit oversold. We do know that when it comes to market turns, what we tend to see is that we have usually a strongish run through the start of October, potentially in pre-election years, a bit of a drop, which may make sense through the middle of October to the late part, and then a rally that usually runs from the November period all the way through to December and what we call the Christmas rally. Now, while election years tend to be worse for markets, Pre-election years do tend to have that really big stat run up. And of course, we've already shared this several times before. It's something we've been running with for literally multiple months here, where we thought there'd be an August sell-off. We were all correct together, of course, on that. We thought we'd see a doubling bottom on through September, which so far we have seen. A new low was formed exactly as we thought. And then from that point on, October, November, and December tend to be those rally months. And you can see while there can be some negativity in these months, by the time you've taken all three into consideration, you usually have a 12-0 run. Now, that's, of course, just a stat, and you could say this time is different, but it's something that we are interested in looking at. Let's talk gold for a second here, because we talked about how gold hit a critical level the other day. This is gold spot realistically, and we can see here, well, it's gold shares, but you can see that the market took a new low and then it started rallying heavily, and it looks like spot. So what do we expect? Well, we kind of expect it to go a little bit higher. Some large transactions coming in for both gold stocks and gold spot, and it's a positive sign for gold traders that we might have just found a bottoming effect. And we've already discussed that several times on this channel. But let's talk about whether we just saw sellers coming into the stock market. This is a critical point around here at this 433, 435 on the S&P. And what we know is large transactions are starting to come through. Are they profit targets? I would say yes, they probably are a little bit. Here's ProShares Ultra S&P, 2 dark pool transactions coming in at the highs near the close. And we get the same thing here from UPro, and we get the same kind of thing here from several of these markets. Now you can see with zooming out a little bit that these dark pool transactions can be quite important. This one began the rally, this one began the sell, this one begins the question mark. Is it a purchase or is it a sell? Well, it's happening right at what we would call resistance. Previous support zones through here become resistance. We've got supply in here, and we've got a lot to discuss later on today's session. I do want to mark treasuries again. This is from the previous video that we already talked about this. 2 large transactions. And while we've seen absolute piling on of treasuries, I do like what we've had happen over the last couple of sessions. Basically, we've seen what we would think is a temporary base on the small timeframes. And if that continues to become a rally, then it could be a good sign for treasuries traders. The first proper sign now in what seems like probably about a 35% drop from the previous high point. Let's talk about what's going on in options. It was a low week or low day start to the week. That's because we, of course, had the bonds market closed. Only 29 million. I won't talk too much about it. 54% calls, so 46% puts. So a little bit more towards the call ratio. And there weren't too many outlying kind of things here. Although we still see Nextra, look at the movement here. It's moved from calls, so calls was a big thing, into quite a lot of puts now. So we're starting to see the puts stack. And if we see more puts stacking on Nextra, that's going to be a relatively positive sign towards a potential bottoming effect there, which we already talked about with utilities. What did best over the last 24 hours? Well, it was what usually does best a day after these kind of bits of news when the market opens. We had energy. Yeah, we kind of expect that to happen. And of course, gold. And again, that is an expectation. We also saw utilities coming through in the middle, but were defensives leading the charge? The answer is quite simply no again. And while, yes, okay, semiconductors were a little bit weak on the session, we haven't really seen a huge move into defensives for that 2 to 3 days that we usually look for. When we go over to the 5-day average, though, utilities really posting a lot better. You can see here it's now the second best, and you can see communications, technology, and semis still doing quite well. And it's a mixture of defensives thanks to healthcare and utilities, but gold was number one, and gold really pumping through, and possibly a little bit more to go in it for sure. And when you look at it on the charts, let's move over to the charts themselves, and we'll start off here with the indicators. Then we'll get into, of course, some commodities. We'll go into some single stocks, and then we'll end up with the indices. So first up, I want to discuss this one here, which is yield inversion. We already discuss it all the time, but basically until this goes underneath that 1%, set your alerts for that. We're not really sure that we're out of what we call like the recessionary period, pre-period, and we're not moving into a recession being called. Generally, you need yields to go underneath. I think it's like never before have you had a recession being called before this thing's going underneath. So just remember that, and we're going to continue to watch it. Both yields were down though. 2-year was down, 10-year was down. So they were both finding that kind of sell pressure coming through. And this is because people are expecting now the Fed to take the foot off the pedal a little bit in raising rates due to the uncertainty of the world. And of course, when we have these uncertainty things, people tend to tighten up anyway, which can have a kind of kick-on effect to, let's say, dealing with the inflation issue and dealing with the hotness of the economy. We did see defensives absolutely rocking it in terms of everyone was buying those stocks. And that's a choice if you wanted to go down that line. HYG, though, I usually find that it's actually very, very quickly done, though. That move, like when that Russia-Ukraine stuff happened, we saw a very quick move up, and then, of course, it dumped off for the next 12 months. So you got to be very careful about those moves. Let's talk bonds, high-yield junk bonds. Were they doing well? Quite simply, yes, high-yield junk bonds found strong recovery. And take a look at this volume down here. Wow. Okay. Now, I know that's all got to do with options and everything, but this was a huge transaction that was occurring here. And we saw that across so many markets. This was where all those puts got wiped or got put into the market. And it kind of what I think it did was it put a wall in for the rest of October. We'll talk about that later on today's video and more subsequently in the next video when we really deep dive into maximum pain coming up next week. But here is the HYG. Basically, we have junk bonds holding their lows, so that's pretty strong. We've got LQD or corporates. They're finding, again, strength right at those previous lows. And when you consider where yields are, they're actually a bit stronger than they were last time during 2022. What about the old central banks? What have they been doing? Well, they injected the other day, which we spoke about, and that helped us to kind of form that bullish bias that's coming in. But look at this again, S&P 500 20 moving average, supply, a lot to discuss later in this video. The move index or the volatility of the bonds themselves is dropping out. We've also got a movement down in things like VIX as well. So even though that's spiked over the last 24 hours, if we load this up for a second here, you can see it spiked and then dropped straight back down. That's the daily. So the VIX and the VVIX, which is what we mostly use now, which is the volatility of the volatility, is also dropping off pretty substantially. The S&P versus the commodities. Now, this is an interesting chart. S&P 500 in recent weeks actually beating out commodities. We could be in what we call a commodity super cycle, which again, we'll discuss in an upcoming video. So make sure to subscribe. A lot of stuff to talk about there. Some things I was talking to people in the US that are experts in their field about commodities. They had some great points and I'd like to share them with members of the community. Obviously, you guys, I thought it would be something that's great to bring back from experts that have really studied this stuff. So we'll go talk about that. Dow Jones Transportation Average Index. This one's back to the 20 again at resistance. So this is where we expect if the bears are going to return back into the markets, they kind of need to do it right around here. Same thing for home builders. You can see home builders coming back to our trend line. If this trend line busts, and then of course 78 busts, I would say at that point, we've probably hit the lows for 2023 so far. And then we look towards 2024 being a weaker point. Semiconductors, another one, very, very strong over the last 24 hours, even though it was only 0.26 down. So it actually ended up down. It managed to rally back up and it's still holding above this zone. Now we know where the issue is for semis. About 150, 150 is the issue point. So if we keep moving up to semis, you would think we usually sell off around that 61.8 and that previous supply. But at this stage, semiconductors are still holding up, even in light of everything that's going on in the world. And again, it just shows you that sometimes we have to put our opinion at the door and we have to react to the market rather than predict based on the information that we're given by the news, by the media, by everybody else. Because as you just saw over the last 24 hours, that would have got you into trouble. Let's move over to copper. Copper is rejecting this low again, finding a bit of strength. I'm going to put a little copper trend line in here. I don't usually use trend lines, as you guys know, because I find them to be a little bit too subjective. And I know TA can be subjective in itself, but trend lines, they can be shockers. Let me know if you agree in the comments down below. You can. I've seen some weird trend lines being drawn. You know, people draw some strange stuff on charts. Anyway, we have here a series of lower highs, and you can see that it is probably a pretty solid trend line. If we breach this, again, I think that's a positive. 3.8 is going to be a big thing on copper. And that's going to tell us a little bit again about the recovery, about the strength of the market and all these types of things. Let's move over now to the US dollar. Weakness continuing to ensue. Now, you would think that in light of everything that happened, the US dollar should actually probably increase. But because yields went down, the dollar's going down, I think we might have seen, that's a big call if it's true, we may have even seen the top of yields. And a lot of this will come down to the US dollar, but a lot of things synced together. Gold synced, dollar synced, yield synced with the high, the way they all moved. We saw oil get absolutely trashed last week. And then, of course, now it's recovering. So unless oil's going to keep moving up, that's been free, like kind of front running a lot to do with yield. So dollar index, same thing from the previous session. Underneath the 20 is what we want to see, and underneath 105.31. Until that happens, we're basically still in an uptrend for swing traders. Let's move to gold. Now, I put a little like signal here, and I don't know if it's true, but about 1875 is where I expect gold to find some weakness. Somewhere in here is where you think gold might weaken. We spoke about that. So I still think there's a little bit more for gold, and I still think there's a little bit more strength there. Gold stocks, they came right to the resistance, couldn't get through there. So again, 27.58 is the alert. If we get above that, kind of marks, I think, a bottoming effect for gold back up to 29.79, that kind of thing. And I think it has swung a significant low. So again, gold stocks are well under spot at this stage. Energy stocks, everyone's talking about them. I don't know if I'm that bullish on them, really. I know everybody else is, but realistically, I could see energy stocks coming up to fib levels, to problematic zones, like such as the 20. You can see here, 20 was bounced a few times, kind of pseudo bounced, and then now we're getting back up to that zone. I'm not huge on energy stocks at this stage, even though I think they've got a little bit more to run on them on the upside. Everybody else would be super bullish on them. I get it, but yeah, I'm not too sure about that. We also saw volumes absolutely blitz on utilities. We talked about the double bottom in the previous session. I still think this is probably recovering at this stage. It was capitulated. It was absolutely destroyed. And utilities got destroyed. I mean, Nextra was just getting flogged every single day. But similar to some of the healthcare stocks, maybe a few of these are oversold and they're starting to find some recovery. At this stage, we're looking for pullbacks to be met by bull demand. We're still looking for that 88 to 89, kind of 90 zone where the supply is, the 20 moving average on the higher time frames, pullback levels, all those types of things. Oil is still in a downward trend after getting hit last week. So even though a lot of people are going to be bullish on it, there's a lot of reasons to say that around that 89 level is a critical bearish resistance zone. So yeah, oil is very important to be watching at this stage. Pullbacks to be met by bull demand. And then we're looking at the 89. Let's move over to Tesla, still having an issues with the 61.8 with this retracement level. The trend is still up for now, but Tesla traders will want to be marking out these lows around 250. I think that's still a critical psychological level for Tesla traders. And a lot of this will come back down to earnings. I mean, earnings is not far away now. So you can make an argument either way. A lot of people are probably putting head and shoulders here and saying, look at this. There's the left shoulder. There's the head. There's the right shoulder. Let's go down towards the short. I'm not convinced either way at this point. I think it's going to be a fundamental discussion. And the overall technicals, up to this point, up to the gap close, cool, that was pretty good. I'd be towards the bull side at this stage just because that's what the market's telling you. But if you're a bear, you want to hold this 260, 263. If it gets through and it actually bounces above like this high here, maybe 265 plus, then the bulls probably have control of that market. AAPL, very good stock usually during October, has lived up to those expectations so far, and it moves towards the resistance. So again, we have alerts. If we get through this point, it could mark the low point of markets. So where are we? We're at critical supply over the next kind of $1 of Apple, and markets will make a big decision, I think, moving forward this week into the inflation numbers. Let's move over to the German 40. Not much to go with here. As you can see here, the German market is pretty stuck. Let's have a look at the Oz 200 just so we can have a look at the differences here. Again, the Australian 200 is it's probably put in a temp low, which is what happened over here. That was pretty excellent buying, similar to the US stock market. This is the issue though. Look at that supply. And where do we find ourselves? Right there. Why? Because every market is doing it. And if we get through these supplies, we get through 70, 90, 7100, that's going to be such a big point here for markets. Same thing for the Russell 2000. Take a look at that low. That's demand, 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 demand. And again, it's becoming demand. Imagine if it got through 1810, as I mentioned to our private trading group. The thing here is this is a huge level should it be taken through. And why? Because it's a critical zone that everyone's going to be looking at markets. And just as you think about it, it's all syncing pretty well. So you again got a trend line here as well that's going to hit at the same point. Imagine when that happens. Oof, it's going to be critical. But Russell 2000 is way behind the rest of the markets. Let's have a look at some of the others. CQQQ, Chinese market, trying to find base low. We'll mention that if it does happen. The Qs absolutely blitzing. They've got possibly a little bit more run up to go, maybe a 369 for the Qs. They look like they've got some more action that could happen here. And you can see the beautiful base on the futures market for the Qs. So the NASDAQ really finding that strong looking base, a much better market look than the S&P. But as always, we use the S&P as the key critical zones. Even if you trade NASDAQ, generally I like to use the S&P 500 as a bit of an idea of whether it's a real move or not. And at this stage, where are we? We are at previous supports, becoming resistances. We've got supply demand traders here. We've got a lot of confluence at this zone. Look how big that level is here on the SPX. We've got a gap fill at 4403, which is going to be that final push. But I think if we're going towards that gap fill, we're more than likely going to see pullbacks being met by bull demand. So this is critical for bears. Bears are going to want to sell here. And we did see that large transaction volume coming through near the close. I think that's telling for the next 24 hours. It could be that bears sit actually around here. Big relief rally. Now we see a bit of sell-off. Maybe we see a little ramp. If we get a little ramp early with a bit of sell-off, probably tells you bulls are in focus. But there's the daily. Let's have a look at the 2 hour here to understand better. This is the supply. This is key. This is a big zone. Now we've gone above that. Okay, cool. Those all the people that have stop losses above here towards short, they just lost. They're done. Goodbye. See ya. Unfortunately, those people have lost their positions. Now, some people have stop loss above here. What if they get wiped as well? This zone here on small time frames is going to be critical. And ahead of CPI and ahead of, let's say, the big news announcements such as economic events and stuff like that, such as the earnings this year, I just feel like it's going to be very tough to knock this level around too easily. At the moment, the trend is up, but I would be looking at small time frames for technical reasons, potentially for shorts to be getting excited at this level. If we manage to get through 43.55-ish, then I think we're going towards that 44.10, and then we'll make a decision based on that gap fill. And you'll notice that, again, that syncs pretty well with the NASDAQ and with the Russell 2000 maybe having an outperformance near the lows. We've got some great stuff coming up as well about yields and bio and yields and Russell 2000, because if we do see a topping of yields here, and they have, and of course we don't know that yet, then we could be in for a very interesting time. So we won't talk too much about maximum pain right now because I want to see how it plays out when we get some more options, and we will have that in our next video. But let's move over to Bitcoin and Ethereum. And you can see here Ethereum is, yeah, it's pretty weak really. I mean, there's all this stuff going on with the staking and the new ETF and all this stuff that's being talked about. Here is where you would have liked Ethereum to find some buyers, and it just didn't do so. It came back down to here. And if you're looking at this chart, you're going, oh, that looks pretty weak. Let's have a look at Bitcoin in comparison, which has been better trading. That's still in an upward trend at this stage, and we're trading around that most traded zone. I would like to see Bitcoin spike up to around 29,500, 30,000, and that's where I'd like to see if sellers are going to actually pressure it down. So at this stage, Bitcoin still hard to trade, mostly looking to the long, but Ethereum looks a lot sicker on the charts. Do keep in mind all of the economic events happening this week. Core PPI, 8:30 a.m. New York time, guys. FOMC meeting minutes, 2 p.m. New York time. That's another one we need to be looking at. Then we've got core CPI. Who even knows what the market wants right now on this thing? And with oil and everything that's going on, you'd have to assume that they're probably right on the forecast at going down a little bit, 3.6%. So this is 8:30 a.m. core CPI. And then if we go all the way down here to the end of the week, you can see that we've also got some prelim UOM consumer sentiment. But really, it's CPI Thursdays and Friday bank news and the economic outlooks that they're going to be giving us that really will move this market. And that will give us a large kind of idea of how maximum pain is going to play out in the subsequent weeks. Because remember, the big options expiration is just about to happen. And we saw Wall Street adding monstrous puts over that zone. So, and this is from a while ago. So they've closed a bit of them now, but it looks like we've got some put walls. At this stage, it does look like markets are trying to defend those kind of low points, and we're kind of in a limbo land. But yeah, if the bears are going to take control, it should be around this level. So it's definitely worthwhile focusing on the small time frames, and of course, practicing your own risk management and taking your own risk into consideration. Thanks so much for watching. If you enjoyed today's video, remember to subscribe and smash that like button. Follow us over on Twitter X in the links in the description down below. And if you want to find out more about some of the courses and how we read these markets and everything else like that, we'll be doing a new newsletter as well. But you can jump on over to fxevolution.com. That's fxevolution.com. Looks like this down the bottom here. And yeah, you can have a look at some of the things we've got. Thanks so much, guys. Bye for now. See ya.